December 7th, 2020. It's only been a few days since a small new investment firm called Engine No. 1 was opened, but their founder, Chris James, writes a letter to ExxonMobil's board of directors demanding change. And not just normal change like laying off employees. No, Chris wants bold change. He says that Exxon's years of poor returns are because of their climate denial, and to fix this, they should replace a third of their board of directors with his slate of 4 new directors, and reduce their emissions, which would involve changing their business model. A bold request, considering his fund was only a few days old and owned less than 0.2% of the company's shares. Not surprisingly, ExxonMobil laughed at the request of a small new $250 million fund trying to push around a $200 billion company. But as ExxonMobil would quickly find out, index funds, even the small ones, have much more power than anyone thought possible. After refusing to accept Engine No. 1's demands, the fund immediately launched a proxy battle against Exxon, which is when large shareholders get together to force change within the company. And while this seemed like an intriguing idea, outsiders were certain that this was unlikely to produce any results. Over 55% of Exxon's shares were held by some of the world's largest funds like Blackrock, Vanguard, and State Street, among others. So reaching the 50% voting threshold needed to make the necessary changes seemed impossible. That said, Engine No. 1 decided to press forward and then launched an unthinkable strategy of winning over the world's largest funds who had historically voted with management. As a result, Engine No. 1 immediately launched a website, a variety of ads, and announced that they were going to spend millions of dollars to get large shareholders to support their mission. This caught Exxon's attention, and they decided to counteract this with a similar strategy. So the two companies were officially in a battle to win the votes of Exxon's largest shareholders. Over the next 5 months, conflict ensued as each of the company's directors put out statement after statement making their case to shareholders. This strategy proved to be very costly, and in total, Engine No. 1 spent over $15 million, while ExxonMobil spent a whopping $100 million. Then, finally, after months of battling, May 26th hit, and it was time for Exxon's shareholder meeting, where both sides would see whose strategy would win out. And while no one was sure how the results would turn out, everyone knew one thing, and it was that Engine No. 1's proxy battle would end wherever Blackrock, Vanguard, and State Street would cast their votes. One by one, the votes were read, and when it was all said and done, Engine No. 1 had 3 of their 4 candidates elected to Exxon's board, and by the slimmest of margins. So Engine No. 1, the small new investment firm, had just pulled off a stunning move and replaced 25% of Exxon's board. And while that was impressive, it would not have been possible without the help of some of the world's largest index funds. The big 3 of BlackRock, Vanguard, and State Street, which combined to own over 20% of Exxon's stock, ended up voting in favor of 3 of Engine No. 1's candidates, giving those candidates just enough votes to win their elections, which showed the world the power index funds truly have. Over the coming months, these votes ended up having a massive impact on the way one of the world's largest companies was run. Before the proxy battle, Exxon planned to increase oil and gas production by 25% over the next 5 years. But after the proxy battle, Exxon decided to keep their oil output at the lowest level in 2 decades, a 20% decline from prior forecasts. So the votes of the world's largest index funds totally changed the way one of the world's largest companies operates. And it was all possible because of the power large funds like BlackRock, Vanguard, and State Street have. But how do we get here? Is this really a problem? And is anything being done about it? This is a mini documentary on how index funds control America. To understand how we got here, we first have to go back a few decades to 1974, when a man named Jack Bogle came up with an innovative idea called an index mutual fund. The idea? Instead of directly beating the index and charging high costs, his fund would passively track an index's performance over the long run, leading to lower costs and higher returns than actively managed funds. By 1976, Bogle's new company called Vanguard launched the S&P 500 Index Fund, which tracked the S&P 500, and although this concept was initially ridiculed as un-American, it quickly gained popularity around the world. Investors saw the benefits this new investment vehicle had with seemingly no downside, which resulted in billions of dollars being poured into these new funds. However, as more and more money was invested into these funds over the decades, it started to become clear to outsiders that this low-cost structure did come with some downside, and that was ownership. You see, Vanguard was able to offer reduced costs for investors because Bogle and other index funds use a novel ownership structure. So the shareholders of his funds become part owners of the funds which they're invested in, while the funds themselves own the actual companies. And while this leads to lower investment costs, it also results in these funds owning large chunks of the companies they're invested in, rather than the individual investors. So as billions and billions of dollars poured into index funds over the ensuing decades, some of the world's largest funds accumulated trillions of dollars in assets. This led Jack Bogle, who started index funds, to sound the alarm on the rising power they have, and in his last op-ed for the Wall Street Journal, he said that a handful of giant institutional investors will one day hold voting control of virtually every large US corporation, and their growing dominance will be a major issue in the coming era. This issue also attracted the attention of Charlie Munger, and just this year he said, "We have a bunch of new Emporors, and they're the people who vote the shares in the index funds. All of a sudden, we've had this enormous transfer of voting power to these passive index funds. That is going to change the world. I don't know what the consequences are going to be, but I predict they will not be good." And with that, he was right. Fast forward to today, and it's easy to see what Bogle and Munger meant. Today, nearly $50 trillion of the US's wealth is managed by investment funds, making the US's asset management industry over double the size of its GDP. In particular, this wealth is very concentrated among a few companies, and the big three money managers, which are Blackrock, Vanguard, and State Street, manage over $20 trillion combined, which is also more than the US GDP, a truly stunning statistic. To put this in perspective, they own on average 22% of the typical S&P 500 company, and in 90% of public companies, one of the big three is the largest shareholder. They own 18% of Apple, 18% of Bank of America, 19% of JP Morgan, and 19% of Wells Fargo, among thousands of other companies, which just shows how much money the big three control. And not only do institutional investors control significantly more shares than anyone else, but they also vote at a significantly higher rate, giving them even more control. It's documented that less than 30% of retail investors vote at shareholder meetings, which gives the big three the voting power of at least 25 to 30% in most large companies. And the crazy thing? This number is going to continue to rise as well, as more Americans move their money into passive funds, where the big three control 80 to 90% of the market. So when you add all of this up, this has caused a lot of concern, because since the funds themselves own the actual companies instead of the individual investors, this means that a small number of people control nearly 1/4 of the votes at many public companies' annual meetings. For example, at Blackrock, there are only 70 analysts that control all of their hundreds of thousands of votes, only 60 analysts at Vanguard, and about 12 at State Street, which is a lot of power entrusted to so few people. And even though this hasn't historically been an issue because these funds have always played a passive role in shareholder voting, this seems to be changing in a big way thanks to a new strategy called Shareholder Activism. This shareholder activism has most notably happened at ExxonMobil, but these large funds have also recently inserted themselves into a variety of other issues relating to climate, diversity, drugs, firearms, and executive compensation, among other things, which has turned these once passive funds into active owners. For example, at Union Pacific, Blackrock single-handedly tipped the scale in favor of a proposal forcing the company to provide a demographic breakdown of the employer's workforce by race and gender. They also helped pass a similar proposal at DuPont. Additionally, Blackrock helped pass another proposal at DuPont, making the company issue an annual report on plastic pollution. On the flip side, these large index funds have also helped block a variety of proposals that would have passed with their support. Most notably, the big three rallied against activist investor Nelson Peltz in 2015 over whose slate of directors should be elected to DuPont's board. The outcome of this high-profile proxy contest was determined when the big three disclosed that they were voting all of their shares in favor of DuPont's current board and against Peltz's picks. More recently, Chevron introduced a lobbying bill that got 48% support, but failed to meet the 50% threshold because all of the big three voted against it. The same thing happened with the climate bill at Chevron too. At Kroger, an environmental bill couldn't pass with 45% support because Vanguard voted against it. And at Citigroup, a diversity bill was blocked because Vanguard and State Street voted against it. And these are just a few of the dozens of situations of shareholder activism in recent memory. In fact, it was discovered that in just 2021 alone, 18 additional resolutions would have passed if one or more of the big three had voted differently. So in addition to helping pass certain proposals, large index funds have helped block others. And the crazy thing is that investors have virtually no say in how these funds vote on these issues because they technically don't own any shares in these companies. But that's just the tip of the iceberg, because voting itself only represents a fraction of shareholder activism that these funds partake in. In 2020, Blackrock, for example, issued a letter to the companies they invest in, saying that they need to align with the rules of the Sustainability Accounting Standards Board regarding climate change, labor practices, and data privacy, among other issues. Additionally, in this year's letter, Larry Fink demanded that their portfolio companies set short, medium, and long-term targets for greenhouse gas reduction and issue reports consistent with the Task Force on Climate-Related Financial Disclosures. And if they don't do these things, well, BlackRock might exit those investments due to a high sustainability-related risk. So large funds are putting indirect pressure on companies to change the way they operate, which is a big threat since they're often these companies' largest shareholders. As a result, this pressure is often very influential, and according to a 2021 study by researchers at the University of Colorado, the University of Georgia, and Penn State, they observed that Fink's annual letter caused companies to alter their advocacy efforts to align with his recommendations on topics such as environmental regulation. They also found that within 30 days of Fink's annual letter, BlackRock's portfolio companies tend to file Form 8Ks containing similar language that's in Fink's letter, which shows the influence these large indexes have over their portfolio companies. This trend is likely to continue as well, and in the first quarter of 2022 alone, BlackRock boasted that they engaged with 719 public companies on topics including climate risk management and social risks and opportunities. The large index funds are still inserting themselves into a wide variety of issues. Overall, this has left shareholders on both sides of the aisle unenthused by these large funds' actions, and according to Insight ESG Energy, a governance watchdog that grades the performance of fund managers, the big three earned grades of C-, C, and C+ for their 2021 voting behavior. So the majority of shareholders on both sides have not been happy with the way that these big funds are using their power. Luckily, it does seem like index funds are starting to recognize the displeasure of many of their investors though, and in early 2022, BlackRock announced that they're offering large shareholders the option to vote their own shares. So BlackRock does seem willing to relinquish a lot of their voting power and give it to shareholders, which seems to be a step in the right direction that maybe other funds like Vanguard and State Street will eventually follow. However, until that happens at scale, there's no doubt that large index funds will continue to influence policies and personnel at some of the world's largest companies, and they're going to do it with your money.